Yeah. So can you guys see this PPT, right?
Yes.
Yes.
Right. So, so what I'll start with is the three, and we'll try to keep the session maximum to 1 hour. So I won't take much of your time, but we'll make it as try to make it as interactive as possible. So the three kinds of, and I would request at least the four of you not to be on mute, or maybe if there's a lot of noise at your back end, then you can be on mute. Otherwise, because I'll constantly keep talking, so it'll be like you guys talking as much as me. So you guys feel free not to keep yourselves on mute if you don't have any noise in the background. Okay. So what are the three main statements, financial statements? Can anybody tell me that you use to analyze companies?
P&L, balance sheet, and cash flow.
Great, that's right. So let's look at the important elements in each of those, and we'll go through them one by one. If there's any doubt, or if you don't understand any of these, please let me know. Okay, so we'll then look at them in detail. Yeah. So first, let's look at the PNL. Okay. So first thing, one of the first things in the PNL is gross margin. So do any of you can any of you tell me what gross margin is? What do you understand by gross margin?
The percentage of gross profit as a part of the sales, I think so.
Correct. That's absolutely correct. So Shantanu, what is gross profit? Uh, and there are
Uh,
no wrong answers here. Okay. So I
Gross
want to,
profit is the one you get.
yeah.
It's sales minus the cost of goods sold.
Cost of
Correct, correct, absolutely right. So, see, whenever you run a company and you're making some products, there are going to be some variable costs and some fixed costs, right? So, for example, if there's a company which is making soaps, then cost of goods sold is the cost of the materials required to make a bar of soap. Okay.
Yes.
And also the labor that goes into it. So the worker's salary in the factory, that is called the labor expense, the direct labor expense, that also gets added to the cost of making one soap, right? So
Hmm.
to understand it very simply, gross margin is basically the selling price of the soap minus the cost of goods required to make that unit of soap. Okay. So if suppose you sell the soap for 100 rupees, and the things that you need to buy, whatever chemicals, perfumes, etc., you need to buy, that's 40 rupees, then your gross profit is 60 rupees. And the gross margin is nothing but the gross profit by sales, as Shantanu said. So it's 60% gross margin. Okay. So why is gross margin important? So why is this important? See, gross margin basically tells you uh, whether the company has pricing power or not. Okay. So there are some companies which have a dominant position in the market, and uh, even if raw material costs increase, okay, even if the cost of for a soap making company, the cost of chemicals, etc., increase, they are able to correspondingly increase their selling price and maintain the gross margin at 60%. Okay. So these are the kind of companies for which they have pricing power. Okay. On the other hand, suppose you consider an auto ancillary. Okay. So an auto ancillary is a company which is making small parts for an auto company like Mahindra or Maruti. Okay. So in this kind of a relationship where an auto ancillary is supplying to an auto OEM, OEM is an original equipment manufacturer. It's a fancy name for a Maruti Suzuki or Mahindra and Mahindra, etc. Where do you think the power balance lies? Who has more power, the auto ancillary or the auto company?
auto insulin.
Auto ancillary, Bhavna? Why do you
I
think
think
so?
So they are responsible for supplying the raw materials.
Correct. Correct.
So
But if you are, say, Bhavna, Mahindra is selling a car worth 10 lakhs. Okay. So for that, it is probably buying materials worth 8 lakhs and making a 2 lakh profit. So out of that 8 lakh, it is taking different parts from different auto ancillaries, right? So maybe it is getting the tires from one company, it is getting the gearboxes from one company, electronics from another company. So one auto ancillary is probably only serving a small part of that 8 lakh. Okay, maybe 10,000, 5,000. So now that you think about this, Bhavna, what do you think now? Who has more power, the auto ancillary or the auto company?
I think the auto company.
Exactly. Because, see, for the auto company, you are important as an auto ancillary, but you are not indispensable, right? But if the auto company decides that, okay, you're not reducing your prices, he can completely cut you off the chain. Not immediately, maybe in 6 months' time, but it can just say that, okay, I don't want you part of my chain, and then you lose all your revenue, right? So typically, the power lies more with the auto OEM rather than the auto ancillary. So gross margin is an indication of pricing power. So I'll show you one screen to make you guys understand this. Okay. So for example, can you guys see the screener page?
Yeah.
Yes.
Yeah.
Yes.
Yes.
So on screener, see, this is a very important tool. Okay. This chart, all of you have seen, right? On screener, which shows the
Hmm.
price. So what you do is you hit this more button and you click on this thing called sales and margin. Okay. So what it does is it beautifully illustrates three kinds of margins in this chart. One is a gross margin, this red line, then your EBITDA margin, which is the yellow line, and the dark green line is the net profit margin. Okay. So you see, this is for Titagarh wagons. Okay, Shantanu knows this company. So this is basically a company which is making locomotives and coaches of trains and supplying to the Indian Railways. Okay, so again, the balance of power here lies with the buyer, which is the Indian Railways, and Titagarh wagons has to sort of adjust to the budget that the railway has, etc., etc. Right? If the price of steel goes up a lot, it is not necessary that Titagarh wagons will be able to charge a higher price because the railways will say, "मेरा इतना ही budget है, इसी में तुमको supply करना पड़ेगा," right? And if Titagarh leaves the contract, some other player will come in and take it up, right? तो अगर तुम इनका ग्रॉस मार्जिन देखोगे, लेट्स गो ऑल द वे बैक. सो दिस इज फ्रॉम 2009 to 2021. See how much the red line varies, right? So at its lowest point, the gross margin is 25%. Okay, you can see in that small square, and at the best of times, it can go as far high as 50%, right? So this kind of chart is an example of a company which doesn't have much pricing power. Okay. uh, Probably a cyclical company. Okay, or probably a company that cannot decide what price it will sell at. Okay, this is important to know because typically these kind of companies now won't have too much high valuation, so they will probably trade at a lower valuation. I will now show you the chart of Hindustan Unilever. What does Hindustan Unilever do, guys? Does anybody know?
They sell FMCG products like shampoos and
Exactly.
conditioner and things like that.
Exactly, Pranav. So they sell FMCG products. So everything from soap to oil to everything, basically everyday necessity things that poor people also buy, middle class also buys, rich people also buys, and people buy it irrespective of whether there is a recession or the economy is doing great. So you need these products, right? Let us look at the gross margin for this company. So look at this graph. What does it tell you? Is it different from the Titagarh wagons graph?
Yeah.
Yes.
Yeah.
Yeah, it's in a much narrow band, right? It doesn't fluctuate so much,
Yeah.
right? So that's why these kind of companies, they command pricing power in the market. Okay, if the price of chemicals increases or the price of atta increases, rice increases, they will just pass on that price to consumers like me and you. Okay, and they preserve their margin. So because they can do that, they trade at very high valuations. So typically you will see FMCG companies trade at 50, 40, 50, this kind of PE multiples. Okay, so this is the importance of gross margin. And very useful. So one of the first things that I do when I come across a new company is I have these bunch of ratios at the top. Okay, there are some ratios which come by default, but you can, edit ratios and add new ratios. Screener has a lot of ratios that you can add. So I create this kind of dashboard which quickly shows me, okay, what is the valuation, what is the kind of debt to equity, how much does the promoter own in this company, etc., etc. Then the next thing I do is directly come here. I don't look at the price. I first look at this chart. Basically, it's important to understand what kind of company am I looking at. Is it a cyclical company? Is it a secular growth company like an FMCG kind of company? Okay. So yeah, so that's the importance of, that's why, gross margin is important, right? So next we come to EBITDA margin. Yeah, EBITDA slash EBIT. So can you guys tell me what the full form is for EBITDA?
Earnings before interest, tax,
Yes.
depreciation. I'm forgetting A.
Amortization.
Amortization.
Yeah, exactly. So amortization is also a form of depreciation. It's for intangible assets, like it's for software or things like that, right? So EBITDA margin is another really important margin. Okay, so EBITDA margin is also sometimes called operating margin. Some books treat EBITDA margin as operating margin, and some books treat EBIT as the operating margin. So EBIT is nothing but earnings before interest and tax. So after you subtract depreciation and amortization from EBITDA, you get EBIT. Okay, so this is called the operating profit. Okay, so what does operating profit mean? Operating profit means that
That will be used for day to day.
exactly, exactly. Go ahead, Bhavna. Say more.
Actually, that was Radhe.
Oh, sorry, sorry. Sorry, I'm actually on the PPT, so I'm not able to see who's speaking. I'm sorry, Radhe.
Oh,
Go
no
ahead,
problem.
Radhe.
Yeah, so that will be used for normal day to day running of the business.
Correct, absolutely. So all the operating expenses will be things that you need to operate a company, okay? Which is like your employee cost will be there, your cost of marketing will be there, okay? Your cost of sales will be there. Then if you have factories, then all the costs related to running the factory, okay? Your power cost, your fuel cost, all of these costs, all the costs related to operating a company will be subtracted from the revenue to arrive at EBITDA, right? So the higher the EBITDA margin of a company, the more profitable a company is. Okay. See, not when I first learned about all these things, I used to always look at the PAT margin, the profit after tax, right? Net profit. But net profit now sometimes doesn't give you the right picture, because net profit is it subtracts interest costs and it subtracts taxes from EBIT, and taxes and interest costs can sometimes vary. Okay, taxes especially can vary. It's a complicated subject, so I won't like go into details there, but you will see if you analyze any company on screener. uh, I'll just show it to you. So if you look at these quarterly results and you look at the tax rate, okay, so just check this row here. It is, the tax rate is varying in every quarter. Sometimes it's 21%, sometimes it's 28%, sometimes it's 18%, right? So depending on this number, your PAT number will change. And if you're not careful, if you don't see that, okay, the tax is low, that's why the PAT is so high this quarter, you might think, okay, the company is doing really well. Yeah. So it's often called that the net profit figure is the most noisy figure, okay, because it has all these different variations. And the operating profit or EBITDA is less noisy, because it doesn't have those kind of tax related imbalances. Yeah. So look at the operating profit of HUL, Hindustan Unilever, for the last 13 quarters. It's in this very very predictable and narrow band of 23% to 25%. Okay. And now let's go back to our, the cyclical company, Titagarh Wagons. Now look at the operating profit here. It was 7% 13 quarters ago. Then it suddenly went to minus 3%. Okay. then 1%, then 11%, and now it's somewhere around uh, 9% for the last 2 quarters. So much less predictability. Yeah. So the higher the operating profit, the higher the EBITDA percentage, the better, and the more predictable it is, the better, right? So when companies are valued in the market, no, the market gives a sort of a premium valuation to companies which are predictable. So the more certainty with which you can say what the margins are going to be for a company, generally that company will command a higher valuation. The market hates uncertainty. You know, it doesn't like companies which in one quarter can give you 100 crores of profit and the next quarter can report 20 crore loss. Okay. So any questions till now? Anything that you guys, any questions, any company you've tried to analyze and anything that has come up that you would like to discuss? No? Okay, fine. So,
Nirvan, one thing.
yeah, yeah,
This
Gaurav.
gross margin, when it
Yeah,
expands, that
yeah,
means out of the mix of the value or the volume, your value items or your premium items starts to show
correct.
up more, right? That's what you would then.
Correct. So another factor, good point, Gaurav. So another factor affecting the gross margins is, suppose a company is selling, two kinds of products. One product is your run of the mill vanilla product, which every other company is also making, and the price for that item in the market is fixed. Okay, so no matter if the raw material cost goes up down, the price will more or less be fixed, because if company A doesn't sell it at that price, consumer will go and buy that same thing for the same price from company B. On the other hand, if the company has a differentiated product, okay, differentiation can come from branding, or it can come from actually, product quality being different, right? So in FMCG companies, generally branding plays a huge role. So the stronger the brand, the more trust people have on it, right? So you may want to pay 5 rupees more per kilo for Ashirwad atta versus any other, other brand atta which is not very famous, right? So gross margin, overall gross margin also goes up if your product mix changes. Like you sell less of the vanilla Me Too products and you sell more of the differentiated products. Because in the differentiated product, you will be able to charge consumers more, right? So that's another reason that gross margins can increase. Right. So next is PAT. I won't go into PAT. I'm sure all of you guys know what PAT is. So that's the final profit number, right?
Hmm.
So you subtract all costs, including interest costs, and then taxes, and finally what the company is left with, it is called PAT, right?
Pat.
Yeah. Can you guys tell me what is the relationship between PAT and EPS? First of all, what is the full form of EPS? Does any of you know?
Earnings per
Earnings
share.
per share.
Earnings per
Absolutely.
share.
Absolutely. So, what's the relationship between PAT and EPS? PAT is overall earnings, EPS is earnings per share. So, what do you
It is
think the relationship is?
obtained by dividing that
Yes,
pet by the shares, number of shares.
absolutely. Who was that? Radhe.
Yeah.
Very good, Radhe. So, I'll show you this. So here you see that there's this number called number of equity shares, right? And this is in crores. So Titagarh Wagons has 12 crore shares. Okay. So in 2022, it did a profit of, okay, 2022 is a bad year, but let's look at a quarter. Okay. So in September 2022, which is financial year 2023 second quarter, they did a net profit of 45. Okay. So this 45 translates to an EPS of 4. How does that come? You divide 45 by the number of shares
12.
outstanding. Yeah. So this is an approximate, it's not exactly 12. It must be 11 point something or 12 point something rather, which is why the EPS is 4, right? Because if you divide 45 by 12, it's less than 4. So the number of shares, it's rounded down to 12, I think here. Yeah. Cool. So yeah. Now, can anybody explain to me, or just give your best shot at what do you think is depreciation? This thing called depreciation, what do you think it is?
The value of a fixed asset reduces after a period of time.
Wear and tear.
Right. Right. Anybody else? Okay, so what you said was absolutely right. So depreciation is basically a cost which is charged every year in a company. Okay, there's some background noise at somebody's end, so maybe you can keep yourself on mute and unmute when you're speaking. Thank you so much. So depreciation is basically a yearly cost, okay, that is charged to a company's P&L for the investments that it makes in fixed assets. Okay, for example, suppose tomorrow a company buys a machine for 100 crores. Okay, so it pays 100 crores to the supplier of the machine, it installs the machine, and the machine has a life of 5 years. Okay, so the machine will do its job for 5 years. So depreciation is nothing but the cost of the machine, which is it's called investment, capital investment, because you're buying capital. Okay, anything that is invested like that has a life of more than a certain period of time, it is called a capital investment. So when you're buying a machine, you're actually not buying it. Buying would mean buying inventory, or buying a raw material which is immediately consumed. When you make the product and sell it, it is immediately consumed. Investing happens when the thing that you're buying is going to have a long life, and it is going to give you benefits over its life, right? So if you buy a machine for 100 crores and it has a life of 5 years, then the depreciation cost which is charged per year will be 100 divided by 5. Okay, so why is this done? Have you guys been able to figure out that what is the meaning of depreciation? Like, I am buying something for 100 crores, it has a life of five years. So why am I splitting this 100 crores into 5 years at 20 crores per year? Can Do you have a logical explanation for this?
Is it because they want to reduce their capital investment for that particular year, so they just divide it by
Correct.
five
That
years?
that is absolutely right. That because you're going to use it for 5 years, so why do you want to take the whole charge in 1 year, right? You spread it across 5 years. That is one reason. Uh, any other reason? Okay, so the other reason is, think of it like this, okay? That you buy a machine, and the machine has a life of 5 years. So, theoretically, after 1 year, the machine loses 20% of its life, right?
Hmm.
And after 2 years, it loses 40% of its life. So, as and when the machine loses its life and comes to the end of its life cycle, you keep recognizing that part of the machine cost. You keep recognizing that part of the machine cost in the P&L. So the other way of thinking about this is, suppose I bought a machine for 100 crores and it has a life of 5 crores. Uh, the depreciation charge in the first year, which is 20 crores, will be the amount of investment that I will have to make in the next year to sort of keep the machine, to sort of restore the machine back to its original condition. Okay, so there is a wear and tear of 20 crores, and if I spend 20 crores, then the machine will again go back to as good as new. That is another way of thinking about depreciation. The first way is what Shantanu said, that if you're spending 100 crores for 5 years worth of use, then why do you want to take the cost in 1 year? That's not fair, right? Because you're using it for 5 years. The other 4 years will get a huge benefit, and this 1 year will get a huge penalty. So to even it out, you divide it across 5 years. And the other way to think about it is this: that the machine is actually a physical machine which is undergoing wear and tear. So there are accounting rules which tell you how many years of life a product can have. For example, any computer software, if you buy, okay, Indian accounting rules say that the life has to be 5 years. Similarly, any plant and machinery, all these capital companies, they buy huge plants and machineries, right? Typically, the life is 15 years, right? So there are some rules. You cannot randomly, decide that I will depreciate software over 10 years. You can't do that. Okay. So when you get more experienced in analyzing companies, you will start realizing that checking the percentage depreciation is a thing that many analysts will do to check whether the company is doing any ghaplabazi in its accounting. Because oftentimes na companies will change the life of an asset up or down to manipulate the depreciation figure. उनको कभी किसी साल में प्रॉफिट अगर ज़्यादा दिखाना है तो एक मशीन की लाइफ जो एक्चुअली 5 साल की है उसको 10 साल खींच देंगे ताकि द डेप्रिसिएशन कॉस्ट कम्स डाउन एंड यू शो अ हायर प्रॉफिट आफ्टर टैक्स. Or suppose in one particular year you have a very high profit, okay, you don't want to pay so much tax because tax is just 25% of your profit before tax, right? So you want to reduce that, then you increase your depreciation suddenly. So if there is a huge fluctuation in depreciation, that's usually a red flag. Okay, so just mentioning it. Okay, next is interest. So what is interest, guys? This one you guys should be knowing. It's fairly simple.
Amount that company pays for their borrowings.
Absolutely. So if you're borrowing 100 crores from banks and the bank charges an interest rate of 10%, then every year you have to pay that 10 crore interest. So that will come up as a cost in your P&L. So this comes below the EBITDA. So EBITDA is everything to do with operating expenses. Below EBITDA comes depreciation and interest. Interest is considered to be a financing cost. So that's why it doesn't come in operating profit. It comes below operating profit, right? So, the importance of this is basically see a company needs funds, right? It needs funds to buy machines, it needs funds to buy inventory, raw materials, etc. How does it get those funds? The company has two options. One is to raise equity, which means that the owner of the company puts in their own money out of pocket into the business, or they raise debt on behalf of the company, right? They go to the bank and they say, see, this is our P&L statement, this is our balance sheet, this is our cash flow. You give us a loan of 100 crores. So these are the two sources of funding, right? So if a company does not generate a lot of cash, okay, its operations are such that it is not able to generate a lot of cash on its own, then it has to depend a lot on bank borrowing. So then it goes to the bank, borrows, and therefore has to pay interest costs. So you will see that IT companies usually have very, very good cash flows. So whatever they sell to their company, they immediately get payment from their customers. So they generate a lot of cash. So for further investments in the company, they do not need to take a lot of borrowing from banks. And therefore, the interest cost for IT companies, you will see this across IT companies, it's very negligible. Okay. On the other hand, if you look at infrastructure companies, okay, companies that are building bridges, railway tracks, etc., they have huge amounts of debt on their balance sheet. Because why? Because government is often their client and government doesn't pay very quickly, right? Government, आज तुमने कोई काम किया गवर्नमेंट के लिए तो गवर्नमेंट if it is happy it might pay you after 6 months, right? तो तब तक तुम्हारे पास पैसा कहाँ से आएगा? So you need to go to the bank and ask for loans, and that loan will therefore cause you an interest cost, right? So that is interest. So basically ऑपरेटिंग प्रॉफिट के नीचे डेप्रिसिएशन माइनस करोगे, इंटरेस्ट माइनस करोगे तो तुम्हें मिलेगा प्रॉफिट बिफोर टैक्स. प्रॉफिट बिफोर टैक्स से टैक्स माइनस करोगे तो मिलेगा प्रॉफिट आफ्टर टैक्स. सो दैट इज द स्टोरी ऑफ द P&L. Now let's move to what I consider the most important out of these three statements. Okay, as you analyze more and more companies, you will realize that while pehli cheez that we think about is profit, right, in a company, but as you become more experienced as an analyst, you will realize that the health of a company is actually determined less by the profit and loss statement and more by the balance sheet. Yeah. So let's look at these two things in the balance sheet. So what are assets and what are liabilities? Have you guys come across these terms, and can you try to tell me what are assets and what are liabilities? Any attempt, no worries if you're completely wrong. You guys are learning, so there's no shame in being absolutely wrong.
I think everybody fell asleep.
No.
Is it?
I'll be surprised if they fall asleep. Because
Yeah.
I
No,
think,
no.
I'm to sitting
No,
and
no.
writing.
yeah.
Guys, is this, I
As
mean, give me some encouragement, otherwise I'll feel as though
no,
I'm making you guys sleep, yeah? So don't make me feel as though I'm doing a bad job of keeping you guys awake. So for that sake, at least you guys can speak up from time to time, okay? No worries. So I will,
yeah.
yeah, I think somebody, one of you was attempting. Yeah, go ahead.
So liabilities would be like the sources of funds that come into the company
Right.
and other things, whereas assets would be, cash in hand, etc. Like basically the applications of the funds that have come in.
Absolutely. Beautiful answer. Pranav, right?
No, no,
No,
Shantanu.
Shantanu.
Shantanu, sorry. I'm really messing up the sounds. Anyway, so that is in one sentence, that is a perfect answer. Now we need to understand the answer, right? So liability, as Shantanu said, is the source of funds. So पैसा कहाँ से मिल रहा है, right? To start a business, you need to have a factory, you need to buy machines for the factory, you need something called working capital, which means तुम्हें raw material में invest करना है, right? You have to give 30 days credit to your customers. All this needs money, right? So where does the money come from? That is the source of funds. That's called the liability side of the balance sheet. So if you see here on screener, you guys can see my screen.
Yes.
Yes.
Yeah.
Yes.
So this is the liability side, okay, the top side. Total liabilities stuck. This part is the liability side, and this is the asset side. Okay. You will notice that in every year, the total of the liabilities and the total of the assets, they match. That
Hmm.
is because whatever funds you raise, you apply those funds in one way or the other. It's like the law of conservation of energy, right? There's no leakage. Whatever
Yes.
you have as funds, it has to show up on the asset side because you're applying those funds one way or the other. Okay. So in understanding the source of funds, there are basically very simple two types of funds, two sources of funds. One is equity and the other is debt. Okay. So equity is basically the money that an owner of the company, owner can mean shareholders also, like you and me, and owner can also mean promoters, right, who have started the company. So equity is nothing but the money that promoters or the owners of the company have put into the company, and thereafter, once the company has started, whatever profits it generates, yeah, those profits also keep increasing the equity of a company. Okay. So equity of a company is nothing but what money owners have put into the company, and borrowings are what money the company has borrowed, either from banks or from sometimes they borrow money from promoters themselves. So promoter has a company, but the company is also borrowing money from the promoter because the promoter has a big new net worth and he can afford to lend money to his own company. So a public limited company you should treat as a different entity. So the promoter is a different entity. This public limited company is like another person. Yeah. So it's like the promoter lending to another person. So these are the two different sources of capital. So for equity, these are the two line items: share capital and reserves. Yeah. So
Yeah.
I will not go into the detail of these right now, but whenever you're asked to on screener, whenever you have to check, okay, how much equity does this company have, you just simply add these two rows: reserves and share capital. Yeah.
Yes.
You can read up a little bit on these two terms. It'll be too much if I go into these details, so I'll leave it at that. And then you have borrowings. Okay. So borrowings can be long-term borrowings and borrowings can be short-term borrowings. Okay. So long-term borrowings are generally used for long-term purchases. Like, you invest in a new factory or you buy big machines. And short-term borrowings are generally used for your day-to-day activity. Like you need to buy a lot of raw material because you're seeing a lot of demand coming up, right? For example, let us take the case of Titagarh wagons. So suppose you have received a huge order of wagons. uh, I would request whoever has background noise to keep you on mute, please. Uh, so Titagarh Wagons say has received a huge wagons order from the government. Okay, it has to make 1,000 wagons suddenly. So how will it start making the wagons? It needs all the raw material, right? Iron, steel, brakes, wheels, everything. So for that, it has to pay to its suppliers to get the money, right? So for that, they need short-term borrowings, right? So they go to a bank and they say, give me a 90-day loan or a 100-day loan. So short-term is anything which is less than a year, yeah. And long-term borrowings are borrowings which are for more than a year. So if you click on this plus tab on borrowings, you will get the split of long-term and short-term. And lease liabilities are basically, suppose your headquarters, your office is on lease, right? So you've leased it from the owner of the building. So you also pay a lease charge, a lease rental every year. So that is also a type of borrowing. Yeah. So this is the major liability side understanding. Okay. Now the asset side is whatever money you have raised, either as equity or as borrowings, you are going to invest them, right? How are you going to invest them, and what things are you going to invest the money in as a company? Give me some examples.
Machinery.
Correct. What else?
Land, buildings.
Buildings. Absolutely. What else? I just said something, sometime back in the last example,
Yeah.
that yeah,
Ongoing projects.
absolutely. So ongoing projects means what, Shantanu? Can you what will a company invest in? In buying what?
Suppose, like you said, they've received a order from the railways, so
Right.
Raw
they'll
materials.
buy raw material,
Exactly.
steel, something like that. Yeah.
So that's called inventory, right? So they
Yes.
will maintain an inventory of raw material. So they will have to invest in long term things like buildings, machine, plants, and in short term things like inventory or in funding their receivables. Okay. What does receivables mean? This term you must have heard.
Hmm.
Can anybody tell me what receivables is?
When a company does any of its business on credit,
Absolutely.
uh, yeah.
Absolutely. So, suppose I have built to the railways, I have supplied 1,000 wagons, and the agreed rate for that is 100 crores. So I send them a bill for 100 crores. Okay. But does railways immediately pay the money to me? No, it
No.
will probably pay me after 6 months, right? So that money which is due to me, but which I have not yet received in cash, that is called receivables. Okay,
Hmm.
that receivable, because you are actually recognizing revenue. As soon as you raise the bill in your revenue in the profit and loss statement, you will add 100 crores for that quarter or for that year, but you haven't actually received the cash. So for the next order, suppose you've got another order now, you don't have cash from that sale that you made, right? So you have to raise further cash. So that is called receivables funding. So you need money not only for inventories, but you also need money to fund the credit sales that you have done, right? So the assets, on the asset side, you will see all these things. So fixed assets are nothing but what you guys said, the long-term assets, buildings, machineries, factories, etc. If you hit the plus button on this, you have land, building, plant machinery, equipments, computers, furniture fittings. This is railway sidings is very specific to this company. Then vehicles, something called intangible assets. So intangible assets are like software or any intellectual property that you have, excuse me, and other fixed assets, right? So a big part of your balance sheet. So see, the total asset side is 2,000 crores. Out of that, almost one third of it is fixed assets. Okay. Uh, do you guys know what CWIP is?
Capital work in progress.
Absolutely, Radhe. What is the full? What is the explanation for it? Do you know?
Yeah, so it's the money spent on some capital, but which is in progress. Oh, sorry,
Absolutely,
fixed asset, and it's in
absolutely.
progress.
Absolutely. So you've probably placed an order for a machine, or you're building a factory, but it's only half done, right? So you show it separately. It's not yet a fixed asset. It will become a fixed asset when it starts serving its purpose, like when the factory is completely ready or when the machine is put up. But till the time it's in the intermediate phase, when you've spent the money, but you are waiting for it to become a functioning asset, it goes into this account called capital work in progress. So when you talk about fixed asset, you should generally add these two. Yeah. So 688 plus 5, 693 is the total fixed assets. Okay. Then you have investment. So investments is nothing but if you have any surplus cash left, you will not keep it in your bank, right? I mean, you will not keep it in savings bank or your current account. You will invest it in some fixed deposits. See, we would probably invest in stocks and equity, but companies are generally much more careful with their money. So they will not invest it in something like equities, because equities can go up and down and that can create problems for them. So they will generally put it in FD and they will earn some 4 5% on it. Yeah. So that's investments. And then you have other assets. So this is where the what is called working capital, yeah, which is the day to day investments, they come in. So inventories, trade receivables. Then if you're holding some cash, yeah, so that also shows up. Loans and advances. If you've given some short term loans to, your you could have given the loans to your suppliers or to another sister company or whatever. And other asset items, yeah. Now, you guys must have heard of this term called working capital, right? So, can any of you tell me what working capital is? Okay, I'll
But
explain it to you. Yeah, go ahead.
no, I just remember the formula because I used it yesterday. It was
Sure.
current assets minus
Yes,
current liabilities of the company.
absolutely, absolutely. So, in current liabilities, let's understand what current liabilities is. Then we'll come to working capital. So, current liabilities is basically the major item that you need to think of in current liabilities is trade payables, which means just like you extend credit to your customers, your suppliers will also extend credit to you, right? If you're making soaps and you're buying chemicals from a chemical company, the day you get the chemical delivered to your factory, you can afford to pay the money for that chemical 90 days later, right? So it is
Yeah.
just the exact opposite of trade receivables. Okay. And what it does is it gives you your raw materials for a 90-day period without having to spend any cash. So suppose your trade receivables are 100 crores, which means you are due to receive 100 crores from your customer, but your trade payables are 40 crores, then your net receivable is only 60 crores. So the 100 crore cash that you haven't received, you have been able to offset 40 crores of that because you also haven't paid 40 crores to your vendors or your suppliers immediately, right? So the major item there is trade payables. So working capital, like Shantanu said, is current assets minus current liability. So current assets has all those items for which you have to fund, like you have to put in money, and current liability is all those, the exact opposite of that is all those items where you are getting something without having to pay cash for a period of time, right? So working capital is just the net of that. If your current liabilities were zero, then working capital would be just the current assets, कि तुमको कितना पैसा धंधे में लगाना है डे टू डे धंधा चालू रखने के लिए. या वेरी सिंपली पुट, इन लाइक लोकल लैंग्वेज, दैट इज हाउ यू शुड अंडरस्टैंड वर्किंग कैपिटल. कि एक तो है मशीन लैंड ये सब खरीद रहा हूँ, लेकिन जो मेरा डे टू डे ऑपरेशन है उसको चालू रखने के लिए कितना पैसा मुझे बिजनेस में डालते रहना पड़ेगा. And the formula for that is current assets minus current liabilities. Generally, we don't consider all the elements of current assets and all the elements of current liabilities. One simple way to think about working capital is you take two items from current assets, which is inventories plus trade receivables, and you subtract trade payables from it. Okay, that is one a watered down version of working capital. So inventories plus trade receivables, these are the two things that you have to fund, and trade receivables, trade payables is helping you offset some of this funding. So the net amount is your working capital that you have to invest. So let us look at this company, Titagarh Wagon. So March 2022 में इनका इन्वेंट्री है 504 करोड़, ट्रेड रिसीवेबल्स इज 659 करोड़. या so if you add these two, it's 1163 crores that you have to invest in the business, and their trade payables is 439 crores. So 1163 minus 439 crores, right? So that will be what? 724 crores. So 724 crores is the net working capital. If you have to go by the book, then obviously you just subtract the other assets of 1607 and subtract 903 from there. So that is a higher value. But for all practical purposes, you can consider these three items only in working capital. Yeah. So do you understand? Are you now getting a feel of what working capital is?
Yeah.
Yes.
So
Yes.
जो great. So जो पैसा the company raises, it raises for two things. One is for fixed assets, which are long term, and the other is for daily operating assets, which is called working capital, right? So the elements of working capital are on two sides of the balance sheet. So the current assets are on the asset side, and the current liability is on the liability side. Sometimes you can show the balance sheet, you can remove the current liabilities from here and just bring it to the asset side, but with a minus sign. So you, instead of showing the current liability of 810 crore here, you can just delete this line, delete this entire line from the liability side, and just subtract 810 crore from this line. Yeah, it will be the same. So your liability side will reduce by 810 crore, your asset side will also reduce by 810 crore, and you will only show the net working capital as one line item on the asset side of the balance sheet. Yeah.
Yes.
So then these two figures will match. This is very important. These two figures have to always match, because just like energy cannot leak, your sources of funds also cannot leak. They can leak sometimes, but at least on paper they cannot leak. Yeah. So maybe the promoter is leaking funds into his own account, but on paper he will continue to show that everything is matching beautifully. And it is our job as analysts to figure out if there is any hanky panky going on. Yeah. Right. So this is why I was saying that balance sheet is the heart and soul of a company. See, uh, think of it this way, that a profit and loss statement and a cash flow statement probably tells you how well a company is doing. Okay. Right now, the health of the balance sheet tells you whether there is any risk that the company will stop existing one day. If a balance sheet is healthy, then the company, you can assume that the company will continue to exist. We have heard of a lot of companies, right? ILFS, a lot of real estate companies going bust completely in 2010, 2011. Enron was a big company in the US which went bust. So the health of the balance sheet, if it is healthy, then at least as an investor who's putting money in that company, you don't have to worry कि कल company रहेगा ही नहीं शायद, right? And the profit and loss, and so first is existence. So first health check is balance sheet. If balance sheet is okay, then you can go to profit and loss, cash flow, and do all other kinds of analysis. Yeah. So yeah, we have covered all of this. So yeah. So now coming to cash flow. Yeah. So cash flow is important to understand. I'll not take a lot of time here. I'll go quickly through this, but appreciate just one thing. Yeah, I just gave you an example sometime back of Titagarh wagons, which received an order of 100 crores. It made the wagons, supplied it to government. It raised a bill to the government for 100 crores. As soon as it raised a bill, it recognized that as revenue. So in the profit and loss statement, you have booked 100 crores. Yeah, but you won't receive the cash for it for 6 months. So your cash flow actually till the time you receive it from that order is zero, right? So appreciate the difference between cash flow and your accounting number, which is the revenue. Revenue is an accounting number. Cash flow is a real hard reality, right? If in an ideal world we were living where every time you raised a bill, you automatically got the cash in your hand, there would be no difference between the revenue and the cash flow. But because this difference exists, the cash flow statement becomes very important. So I won't go into too much detail, but I'll just explain to you how the cash flow from operation item is calculated. And Screener has a beautiful way of showing this. So if you go down from balance sheet, so first is P&L, then you come down balance sheet, then you come to cash flow. Yeah. So if you just hit the plus button here, it shows you the flow of how, you know, from EBITDA you reach cash from operating activity. Yeah, this will take you guys a lot of time to fully understand. It took me a lot of time to finally understand how, an EBITDA figure matches with a cash flow from operations. So don't get overwhelmed by this. Just try to understand conceptually what this is trying to tell you. So it starts with EBITDA, profit from operations. If you go up, I'm going up to the P&L, you will see that. Okay, why is the figure different? This is 206 crores, but in March 2022, the operating profit is 133 crores. Surprising.
Yeah,
Let's
yeah,
take
there
another.
are inconsistency. I've also seen that.
Yeah, yeah. So let's take a easier example. Let's go to Hindustan Unilever. So here for 2022, it's 12,857 crores. Let's hope. Okay, it's more or less matching. Yeah. So 12,857 crore is the EBITDA, and here it is shown as 12,829 crores. Yeah. So what it does is, you start with the EBITDA figure, and then you make a series of adjustments, right? So suppose, just to give you an example, suppose your profit from operations was 100 crores, okay, but your receivables, last year your receivables were 50 crores. Now end of 2021, your receivables were 50 crores. Now your receivables have become 100 crores, okay, at the end of 2022. Which means what? Which means during the year, you have had to fund 50 crores more receivables compared to the last year, right? Which means that your cash flow generation has reduced by 50 crores. So your operating profit number will reduce by this difference in the receivable number from 1 year to the next year. So if it's getting too complicated, don't worry. You don't have to completely understand this. I just want to make the point that appreciate the difference between accounting profit and actual cash generation. Yeah. Why is cash generation important? Because the day the company runs out of cash, the company ceases to exist. Because it may not always be able to go to a bank and get a loan immediately. Yeah. So it is very important for the company to keep generating its own cash. If a company has great revenue, 10,000 crores, but every year it generates only 100 crores of cash, that company is as good as worthless. Remember this always. Yeah. Tomorrow I can open a shop and sell everything on credit ना. मैं एक पान का गल्ला खोलूंगा और मैं बोलूंगा सब पान लेके जाओ, और मैं रोज लिखता जाऊंगा कि हाँ भाई मेरा आज 10,000 रुपए का सेल हुआ, लेकिन मैं किसी से कैश लेता ही नहीं हूँ, मैं बोलता हूँ जब मर्जी दे देना. तो डज दैट कंपनी हैव एनी वैल्यू गाइस?
No.
राइट. तो उसी का, दैट इज अ वेरी एक्सट्रीम एग्जाम्पल. उसी का actual example is how efficient a company is in generating cash from its operations, which means how fast does it recover money from its customers, how late is it able to pay its suppliers, and how much less inventory can it run its business with. If it optimizes all these three, it will have very very good cash generation. Yeah. And cash is king. You will hear this sentence from time to time, and the reason behind that is this: that if you run out of cash, your business basically stops. Yeah. So there are three kinds of cash flows basically. One is the cash flow from operations, which is buying, selling, and your day-to-day operation, how much cash was generated from there. The second element is called cash flow from investing. So it is shown here, which means have you spent any money in buying factories, machines, etc., which is fixed assets purchased. Then if you have sold any capital goods, like if you had an old machine, you sold it and recovered some money, so that is subtracted. And then similar things, investments purchased, investments sold, etc., etc. So this is the cash you generate from investing. And the last element is cash from financing, which means have you raised more money from debt? Have you gone to a bank and raised money as debt? Or have you raised money as equity? So, for example, this was a private company, and this year you did an IPO and raised 200 crores. So that will show up as proceeds from shares. if this company did an IPO or an FPO in the market in 2022, it will show up as plus 200. Yeah. So proceeds from borrowing. So this company has borrowed 55 crores this year, and it has also repaid 55 crores. So the net increase in debt is zero for this company. Okay. Then interest paid, whatever interest was actually cash interest was paid, is also reflected here. Whatever dividends was paid is reflected here. So these are the three elements of cash. So you start with, at the end of 2021, you had say 100 rupees cash. Then you generated some cash from operating activity, say 30 rupees. So your cash balance became 100 plus 30. Then you spent 20 rupees in buying machines. So your cash balance became 110. And you also raised 20 rupees from banks. So your cash balance went up to 130. So at the end of the year, last year was 100. This year your cash balance is 130. Okay. So that's how the cash flow statement works. So I think we are already up to 1 hour. uh, Gaurav, I think I have one more slide on ratios,
Hmm.
which is pretty heavy. So like, I don't want to cram a lot of things, so let's take it easy. So we can do another session whenever available. I mean, I am ready to do it tomorrow as well, if you guys are all available. What say, Gaurav? Shall we like stop and take any questions here and resume again in another
Yeah, yeah.
session?
I think Nirvan, two things that we can do. I mean, stop, take question, also give homework.
Yeah, right, right, right,
Yes.
right. That's actually a good idea. So before looking at homework, guys, any questions you guys have on the material we covered, or any other thing that you guys are struggling with in the last some days related to P&L, balance sheet, cash flow? Be happy to try to resolve. Okay, you don't have to mention it now, but anytime that you guys feel that you have any queries, I think, Gaurav, we can set up a page on a Notion
Hmm.
separately for queries, or maybe they can reach out to me directly also. That also works.
Sure.
Uh, there should be just a mechanism for collecting queries, so that once a week or whatever, we can sit and discuss with them and have a discussion to resolve those doubts. Yeah.
So Nirvan, that group that is there with Shantanu, right?
Yeah. Yeah. Yeah.
Shall I add all of them into that group? I mean, that becomes a general query session because anyways you can talk to Shantanu on phone
Sure.
or
Sure.
on call or something like that, right?
Sure. That works. That
Yeah.
works.
Because
Yeah.
I'll be spamming the other group where these guys are there.
Sure,
I
sure,
don't want
sure.
to disturb you there.
Yeah, yeah, no worries, no worries. So
All
you
right.
can also add them with Shantanu on that group. Yeah,
All right. Cool.
cool. So as part of homework, there's not homework, okay? So don't consider it as work. It's basically whatever we studied. It's a tool to help you guys cement these learnings. Yeah. So this already Shantanu has looked at it. Uh, Let me see. I'll share my screen again. Yeah. So, sharing my screen. Let me know when you guys can see the screen.
Yes.
Yeah. So, Shantanu, you already know about the sheet. Have you had a chance to discuss this with the other three?
No,
No,
I
right?
haven't.
Okay, good. So, the other three, Radhe, Pranav, and Bhavna. See, this is a sheet that I made, which basically has all these metrics, okay, taken from P&L, balance sheet, and cash flow. So the formulae are already put in here by me. Uh, what the beauty of this sheet is, that I've showed this to Shantanu, that on Screener, uh, you can actually, there's something called export to Excel. Have any of you three used this feature on Screener?
Yes.
Yes.
Okay, great. So the beauty of Screener is that not only export to Excel, you can actually change the Excel format. Okay, so if you go to screener.in/Excel, okay, you can actually upload a new format. So this is the format that I've made. which is nothing but all the other sheets that you get already from the screener Excel. I've added one more sheet here. It just picks up values from all these other sheets and calculates all these things like what is the PAT percentage, EBITDA percentage, debt equity ratio, ROE, ROC. Okay. So what I would like you, I'll share this Excel with all of you, or maybe Shantanu, you can share this Excel with all of them. Yeah, you already have
Yeah,
it.
sure. Yeah,
Yeah,
I'll share it on the group.
yeah, you share it on the group, and if any of them are having trouble uploading it to Screener and downloading it, just help them out with it. Yeah.
Absolutely, yes.
Yeah. So the homework, quote unquote homework that I would like you guys to do is you download this sheet for the company that you're analyzing right now. Okay. So it may be Rainbow Hospitals or it may be another company that you're looking at. And you fill up the sheet. So there will be some rows which will not be filled up, which you can fill up looking at the screener page of the company. So the next time we meet, I want you guys to have the sheet filled up for just one company, and then you guys uh, will each take say 5 minutes or 10 minutes to sort of discuss these figures, yeah, and give your views on these figures, right? Like, is the company doing well on its P&L parameters, on its balance sheet parameters over the last 5 years? How is the cash flow? How does it compare with, you know, other companies you have seen? So whatever insights you can understand. There's no format for it. There's no pressure. It is just to, expedite your learning. So is the sort of homework clear to you guys?
Yes.
Yeah, I want to hear this from all four of you. Shantanu, I know he
Yes.
knows this. Yeah,
Yes.
yeah.
I
Bhavna.
do have one question though.
Yeah, go ahead, Shantanu.
Can you just go through the working capital part? Is it the same formula that you'd mentioned, Abhi? Inventories plus receivables minus payables?
Days of working capital, no. So
Yeah.
actually, yeah. So days of working capital, I realized, Shantanu, that this